Hey warm welcome Squick Invest channel. Today I'm happy to discuss investing legendary. Let's run down some of the most influential investors and how their philosophies can be applied to the Singapore market. 1. Warren Buffett. Buffett's love for bank stems from their strong competitive advantages, moats, stable earnings, and consistent dividends. Singapore's major banks, like DBS and OCBC, certainly fit this profile. They are dominant players in a mature, regulated market and have a history of paying out reliable dividends. This aligns perfectly with long-term, value-oriented approach. To Ray Dalio, the all-weather portfolio is a powerful concept. Many investors, not just in Singapore, have a heavy concentration in stocks. Dalio's strategy highlights the importance of asset allocation to reduce risk and navigate different economic cycles. For Singapore investors, incorporating T-bills as a proxy for bonds, REITs which can have some bond-like characteristics, and perhaps a gold ETF can help create a more resilient portfolio that is less susceptible to a single market's fluctuations. 3. Peter Lynch, invest in what you know, is one of Lynch's most accessible and effective pieces of advice. Sheng Siong is a perfect example. It's an everyday business that many Singaporeans use and understand. This fits his growth at a reasonable price GARP model, where you buy a company with strong growth potential that is not trading at an exorbitant valuation. Thai Bev, too, is a product many are familiar with, making it a good example of a Lynch-style investment. For Charlie Munger, Munger's philosophy of holding a few high-quality stocks for the long term is a strong counterpoint to the idea of over-diversification in the context of the SGX, which has a smaller universe of stocks compared to, say, the US. This approach makes a lot of sense. Instead of spreading capital across many mediocre companies, an investor can focus their research and conviction on a handful of market leaders with strong fundamentals and management. 5. Benjamin Graham, the concept of margin of safety is timeless. It's the idea of buying an asset for significantly less than its intrinsic value. Given the recent weakness in the Singapore REIT sector, there may indeed be opportunities for a Graham-style investor. A low price and a solid yield could indicate a potential bargain, provided the investor has done their homework on the underlying assets and management. 6. Cathywood. The SGX is not known for its roster of disruptive, high-growth technology companies. For investors interested in Cathywood's style of investing, they would likely need to look beyond the SGX to markets like the US or Hong Kong, which have a deeper pool of companies in areas like artificial intelligence, fintech, and genomics. 7. George Soros. You're right, Soros's macro-style investing is difficult for most retail investors to replicate. However, his principle of being decisive and cutting losses quickly is a valuable lesson for everyone. This reflexivity concept where markets influence themselves teaches us to be humble and acknowledge when a position is not working rather than holding on to it and hoping for the best. 8. John Bogle. Bogle's message about low-cost index funds is a cornerstone of modern investing. For the vast majority of investors, simply buying the ASTI ETF, which tracks Singapore's benchmark index, or a REIT ETF is a superior strategy to trying to pick individual winners. It provides broad diversification and captures the overall market's return, all at a very low cost. Takeaway 1. Know your strengths and your market leverage what you know. For local investors, this means using your understanding of Singapore-based companies like Sheng Siong and major banks like DBS. This aligns with Peter Lynch's philosophy and can give you an edge over others. 2. Don't just buy stocks. Diversification is key. As Ray Dalio's all-weather portfolio teaches us, a well-rounded strategy includes more than just equities. Consider adding assets like T-bills or REITs to protect your portfolio against different economic cycles. 3. Focus on quality over quantity in a smaller market like the SGX. A concentrated portfolio of high-quality stocks can be better than holding a large number of mediocre ones. Following Charlie Munger's advice, Focus your research on a few strong, well-managed companies for the long term. 4. Think long-term and be patient. Benjamin Graham's concept about margin of safety and Warren Buffett's value investing style emphasize patience. Don't chase trends. Instead, focus on a company's fundamentals and be disciplined enough to wait for a good price. 5. When in doubt, index. For most people, the simplest and most effective strategy is to invest in a low-cost index fund. As John Bogle preached, buying the ACI ETFs gives you broad market exposure and solid returns without the effort of picking individual winners. Disclaimer: this information is for educational purpose only and is not financial advice. Always consult a qualified professional before making investment decisions. Thanks for watching. See you.